Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good. You?
Not bad. It's warm and humid.
Yeah. I know it's around 100 degrees plus in Houston, Texas, and here I am complaining to my family. I'm like, oh, it's barely 85 degrees and humid. Like, you have no idea. And they're just like, you keep your cool days up.
Yeah. We've been spoiled so far in Minnesota. It's been a relatively cool summer, which is not typical for July anyway. So we'll see if things start to heat up.
Yeah, tomorrow I guess might be one of our first 90s, I think.
Yeah.
So we're heading out of town. We're going to be on the water. We're heading out tomorrow morning to go back to my wife's hometown, Spicer, Minnesota, and get out on Green Lake.
Those pictures you sent over the 4th, just beautiful. Looks like that lake is really nice.
It is. Yeah, it's just a really kind of cool town and really cool people and just a lot of fun. The lake's super clear. One of the clearest lakes I've ever been on. And they act a little piece of trivia. We have the St. Paul Winter Carnival. And I'm not sure if they still do, but maybe they still do, but they've done it for a long time. They'll get the ice for the ice castles out of Green Lake.
Cool.
So that's how clear that lake is. And yeah, it's cool, real cool area. We like, and it's not too far away. It's under 2 hours. And so you could make a short, weekend out of it. And it's fun. So we'll finally be over the 4th. It was kind of chilly. You didn't really get in the water much, but we'll be soaking it in this weekend. So looking forward to it.
Always good to have those trivia facts ready to go.
Yep.
All right, guys. Well, this week, we're going to be talking once again about creating our own family banking system. And just to reiterate for our listeners, we're going through Nelson Nash's book, Becoming Your Own Banker. Last episode, if you haven't listened, I would encourage you to go back and take a look at that, where we talked about how to create a banking system that's very similar to what you're already used to with a commercial bank. Guys, in this episode, we're going to be talking a little bit more about theory, but we're also going to be digging into some of the more technical aspects about this banking system. So, John, the first thing that we're going to talk about is the truth that Nelson describes as saying you finance everything you buy. Can you describe that a little bit more for our listeners, and how is that really impactful for the infinite banking concept?
Yeah, the statement really does encapsulate a large portion of IBC and the mindset that's required to really catch it. It's caught, not taught. And I think if you catch this principle, if you see how it plays out in whatever your specific situation is, then you can really see maybe what you're losing out on and just what is possible moving forward. So I get oftentimes when I present IBC and I'm talking about it with friends and family, and the number one objection to this statement are those who save up and pay cash, right? I'm not financing my car. I just, it's free and clear. I just paid a whole, lump sum out of my checking account to the car, dealership or whoever. And now I have it free and clear, and I'm not financing anything, and I am debt free, and I am empowered that way, which, you know what? I will definitely agree that it takes tons of discipline, patience, to save up in that way and pay off your car. And for some people, they're even able to, pay their mortgage completely off and be debt free in that way, which is, there are really good principles involved with doing that. But what's missed oftentimes is what you're losing out when you do, say, write that check for the car dealer, or essentially you're not putting that money that's, say, in your checking account or in another account to work in the way that it can earn. And we're saying earn over a lifetime, uninterrupted, which we talk about all the time about, this whole life product that'll do that for you. that you're missing out on otherwise, that is sunk, is lost whenever you do purchase that car. Whereas in IBC, you can capture that interest that you can earn and still finance the things of life, still capture all those things that you're trying to finance. Even, the parable of the talents, it's mentioned at the top of page 21 that we're on right now in Matthew chapter 25. I'll just read the quick verse and explain it a little bit. Matthew 25:27 talks about, you should have put my money on deposit with the bankers so that when I returned, I would have received it back with interest. And what that's getting at is the parable of the talents, right? There's a master and three servants, essentially, who they're given money, essentially. We'll call it, 10 talents for one servant, 5 talents for another servant, and 1 talent for the third. And he leaves for a season and comes back and wants to know what these servants did with the money that they were given from the master. And the one with 10 created 10 additional talents. The one with 5 created 5 additional. And with those two guys, the master's very well pleased. He says, well done, good and faithful servant. And, on a separate note, just I think eternally and spiritually, that's just those words, well done, good and faithful servant. I just cannot wait to meet Jesus and get to see and hear those words, Lord willing. But the third servant with the 1 only dug in the ground, created a little hole for that money, and let it just sit there until the master returned. And he said, well, here's your 1 back. I thought, maybe you're cruel, or maybe you would think of me in a negative light. So I just didn't want to mess it up. And I was fear-based. And, in our world, we refer to that as scarcity mindset. And here's your 1 back. And that's where this verse comes in. He's like, you should have put it on deposit at least and get some interest. And that's that lost opportunity cost that servant lost out on. And he's rebuked. He says, that 1 talent that was given to you, I can't even trust you with that. So let's give it to the person with 10, because I know he's going to be, good and faithful with that money. And I know he's, going to steward it well. And I think that definitely correlates to what we are called to, just as, people with money. We're called to steward it well. We've been given whatever God's given us in our life, and we're called to, use it wisely. And I think that parable in Matthew chapter 25 just speaks to the wisdom that we can gain from at least knowing that there is this like interest factor. There's this opportunity cost to consider, even just at a core level that's mentioned in the Bible, that's way before the modern banking system or any of the money market accounts or stocks or anything that we know exists. We just know that basic principle existed back then, was considered like pure wisdom that we can take and really move forward with our money.
Yeah.
So, go ahead.
I was gonna say, then it rolls in the book here down to where Nelson kind of talks into the specifics of kind of what that concept is. So John talked about the general idea of you finance everything you buy. So this was a really good, when I read the book here, this was really good for me because it actually, he references a Fortune magazine article that talks about where this economic concept of economic value added called EVA was developed. And that's the economic, theory that John just, mentioned, is that your capital has a cost. And so if you like the idea of having cash sitting available, liquid, that you can then purchase things with and not pay interest, not go into debt with a lender. I mean, so that has value, right? It does. But what people don't necessarily understand is it also has a cost. Your cash just sitting there in a low interest account, when it could have been used in some other form, gaining higher rates of interest, your net is you're losing money. Your capital could have been better used elsewhere. And then also, the moment you take that cash out of the savings account, whatever meager amount of compounding you might have had, you just broke it. And so that's kind of this key concept of how that's a really, like John said, and Derek said at the beginning of this podcast, that's a really key concept, this whole idea of infinite banking, is that uninterrupted compound growth that you get within your whole life policies versus other, vehicles of storing money. And so, that EVA is the actual, true like a theory behind it. So super important to kind of get that through your head. And it was good to see there's actually a real world concept behind it that Nelson was referring to.
That's great thoughts, guys. And just to also speak back to the last episode where we closed out and we said that what we're utilizing is this participating, dividend paying, mutually owned whole life insurance, as Rob was just describing. There are a couple of things, though, that we need to keep in mind. When you're starting your banking system, you are likely going to be the owner of the life insurance policy. And that comes with a couple of different responsibilities, as Nelson goes on to describe. He's thinking of, say, your vehicle, for instance. If I may drive and maintain my vehicle different than how Rob drives and maintains his. And the life of the vehicle for me might be significantly less or greater than his, depending on how he treats his vehicle. The same is true for life insurance policies. You have to maintain them. You need to respect them, and you need to utilize them properly. And when we're talking about family banking and creating a system like this, what that means is each person in your family, if you're going to be giving loans out to them, they need to respect, maintain, and utilize it the way that it's designed for in order to keep this system going for many, many generations to come. So I think that's such an important truth that we need to maintain it, need to respect it, utilize it the way it was intended for. The ways that you destroy that, however, is not paying back policy loans or maybe taking out withdrawals instead of policy loans. That could also destroy the system, destroy the growth in the system so that you're no longer getting as much of that uninterrupted compounding that Rob was just describing. Guys, what are your thoughts on how we ought to maintain, respect, utilize the policy?
I think a helpful example is to think about the cost of not doing this, right? And that, for example, if I were to not have just say $1 million of death benefit that I'm leaving to my kids, not doing that for my fourth generation, Lord willing, my kids have their kids and following, and not doing just $1 million of death benefit to leave to them could be the fact that we're losing out on a family level of wealth on the fourth generation of roughly $500 million. If you factor in the compounding, if you factor in, and this is at a modest rate, just that one, obviously, $1 million seems like a lot, but if you view it in terms of life insurance and the cost, the risk pooling and the cost aggregation of getting that $1 million death benefit, it really isn't that significant. And especially when you compare that to the opportunity that you're giving your follow-on generations of, say, by the fourth generation, close to $500 million with just $1 million, that opportunity, that loss can be significant. So you're not just missing out on the $1 million, you're missing out on all the dollars that benefit could earn for you.
Yeah. Great point. Great point.
John, why don't you go on to describe a little bit more about when an insurance company collects a premium from the policy owners, what do they do with that premium dollar amount?
This is another huge question we always get. How do these companies guarantee? So, we'll talk about it ad nauseum, but in your whole life insurance contract, it's a contract that you are the owner of. The life insurance company will guarantee growth, uninterrupted compounding growth. It won't be 25%, right? They're not going to over promise and under deliver. But they are going to, by law and by contract, guarantee this growth. And so the next natural question, I think, and I asked the same thing when I was exploring IBC, is, well, how do they do that? And this is a plug also for the case for IBC. There is an actual life insurance company's snapshot of their portfolio of where their general account is invested. And so y'all know, like, a general account is all the money collected from an insurance company via premiums, annuities, whatever it may be, and all those aspects where they guarantee all these fixed returns. So the life insurance company pools all those premiums together. They receive this general account and they put it to work. They make investments, and they're not making speculative, crypto investments. They're not making risky, day trades. They have been doing this for over 100 years, some in the 170-year range. Like, these companies know exactly what they're doing, and we'll talk about it a little later, but actuaries are the ones who can plan out and help tell the company exactly what they need to earn by this X number of years, and really get it down to a science rather than a speculative investment. So conservative investments examples that they use are bonds, like municipal bonds, corporate bonds, treasury, bonds, and some, mortgage-backed securities, stuff that is very, very conservative, predictable, and they know they can, layer their investments and plan it out in such a way where they're gonna pay their death benefits and they're gonna pay, dividends, which we'll also talk about a little bit later, but getting ahead of myself. But they put that money to work so that they can guarantee the present return and future returns thereafter. So that's why we, as practitioners, we have vetted the companies. We know which companies are good, which companies are bad, and we use them ourselves, and we experience the growth ourselves, and we benefit in the same way as our clients do. So finding the right company also is very important. Like, for me, I think knowing that these companies are experts in what they do, like, they've been doing it for so long, and I no longer have to be an expert in planning out investments and planning out returns and stuff like that. I know it's just done in a wise way, in a consistent historical way that's going to result in the same, future returns. So
I like to think of it like a baseball analogy. Sometimes when we think about the greatest baseball players of all time, they may be the ones that hit the most home runs, right? But you could also say some of the best baseball players of all time are the ones that get on base frequently. And the way a life insurance company treats the premiums that they're receiving from their policy owners, they're just trying to hit singles or doubles or get on base as quickly and as much as possible. And to me, that, like you say, John, it brings you a lot of comfort knowing that I've got a financial tool, a product that can help backstop against unnecessary risk that I would have to take in order to reach that type of future potential, future earnings for my family, future death benefit. I've got this company that's been doing it much longer than I am, have more staff that are just chart gurus and everything that can just say, all right, we're just going to get on base every single day that we can. And to me, that would be the greatest baseball player of all time, is if they had a batting average of 1 or 1,000, depending on how you think of it.
Yeah, and they, as we're always, like, all the three of us are always reading and listening, and I have listened to some interviews of CEOs of insurance companies, and they've been, and the ones that we partner with, they've been around for 120 plus years. They know what they're doing. They've never missed a dividend in that. Just get your head around that for a second. They think long term. They have the luxury of long term. They're mutually owned companies. They don't have the pressure of investors, pressuring them, or Wall Street. They can make really smart, strategic, multi-layered plays, like you're saying, John. They have different bonds at different, they age out at different periods, and then they have all of the mutual owners that are taking out policy loans, so they have that income as a real consistent income. So they have all these really stable, predictable, and the same mantra. Whenever you have really stable, predictable compounding interest, the scale of it gets so immense. And so then they have multiples of reserves in their general funds that over the years so they can cover they've been doing this for so long and they do it so efficiently. It's just the best place to put your money. And yeah, they have the years of being able to like aggregate risk, and they can do it on scales that we can't, right? So what a benefit. An individual person, we can basically get our money managed by the best money managers that have been around for the last 120 years. It's really why would you not want to do that?
Mhm.
And so yeah, that's partnering up with an insurance company. You're a part of it, you're a part owner, and you're working with some of the most talented people in the industry. It's just, it's a no-brainer,
Yeah. Rob, you mentioned that long-term play that it continues to compound and get better and better every year. Why don't you just, continue with that? Later on on this page, he talks about, Nelson talks about the efficiency of the policy, how it gets just continuously better. How about you, continue on that?
Yeah. So if you if you work with us, we'll make you read the book, basically. If you want to work with us, you got to read the book. You have to have an idea of what this concept is about infinite banking. Nelson Nash's version, well, he's a guy who recognized it and invented it, I guess. He recognized it, he's the first one to really recognize it and teach it and understand it. So Nelson's infinite banking concept, read the book as you're working with us, as we're going through this journey together of getting you set up correctly with your own personal family banking policies. But we'll eventually talk about illustrations, and illustrations have a guaranteed side and a non-guaranteed side. And the way it works with insurance is that a lot of the fees are in the front end. Almost all the fees are in the front end, basically. So you have the commission to the agent, you have the initial startup fees. And so the front end of the illustration, you'll see the cash value versus the premium, is lower. And then eventually, typically in the ones that we design around year 4 or 5, they kind of catch up, and then around year 7, they start exceeding. So that's becoming more efficient. So you got that front end load of fees, and then once that kind of front end load of fees are over, then it's just the standard run rate of the insurance company's costs. And that's basically the same from that point on going forward. But then you'll see that your death benefit is always increasing, but your premium is always staying the same. And so and it's guaranteed every year. So once that dividend's declared, it's guaranteed, and the death benefit increases. And so every year you're paying the same amount of money, but you're getting more death benefit and you're getting more cash value. So just by doing what you're doing every single year, it just gets better and better and better and better. So it's just more efficient. He'll use an illustration about a plane and jet fuel. The jet fuel burns off, the plane flies faster or the same rate for less amount of power put in, or same amount of power put in. So yeah, that is how when we talk about they becoming more efficient, that's a big piece of what all that means.
Yeah, I have like 3 different things to add on that, and maybe I'll forget it along the way. But the first thing I'll say is I don't think there's any other strategy, product, whatever you want to call it, out there financially where you are rigging the game to win no matter what. If you pass away the next day after you have your policy in force, financially speaking, obviously, nobody wants to die before, especially, in many cases. But if you died financially, your family is receiving a huge death benefit in relation, especially to what you put into the policy.
Mm-hmm.
But also, like Rob is talking about, you're rigging the game to win long term. Not only is that death benefit increasing along the way, but your cash value is, and definitely the amount output compared to input every year. You're putting $1 in, it's spitting out, close to 2, 3, even 4, the longer the policy's in force. So you're rigging the game to win in that way. Very few, I cannot think of another strategy out there where you're gonna win. You have so much flexibility and peace of mind to move forward and maybe even take other calculated risks if you want, knowing that you're going to win. Your family's going to win with this in place. The second thought I had is as far as efficiency, and I think I'm going to remember all 3. The second thought I had is your dollars feel less expensive as the years go by with inflation.
For sure.
10K right now compared to 10K 30 years from now, it's going to be a whole different mindset when you're thinking of paying that premium. It's going to feel much less burdensome, much cheaper 30 years down the road if you're able to lock it in right now, because as these whole life policies are designed, they're level or fixed premium amounts for the life of the policy. And the last thing I'll say is efficiency. Like Rob talked about the efficiency of how that dividend increases and how the policy itself gets better and better over time. But another way to think about efficiency is, and we talked about it in an earlier episode, is just that the dollar is just doing multiple jobs. And I don't think there's a way to reach your maximum financial potential without your dollar doing multiple jobs. It's growing, it's providing that death benefit for you. You can leverage it, you can use it as a policy loan for various other investments and even get a return on that. Recycle that money. You can do all sorts of things and have that efficiency, like doing multiple jobs, all just in one product. It's amazing. It's truly amazing.
Yep.
Good stuff, guys. I know, Rob, you had mentioned the word illustration a little bit, and so I wanted to just describe that for our listeners. Basically, an illustration is part of your application and part of the contract of a life insurance policy. And the illustration portion of it is a graph or a table of numbers. It'll show your premium amount. It'll show what's guaranteed as a dividend, what is not guaranteed as a dividend, the cash value, and the death benefit. So that's the table. Will illustrate that for you. An illustration is not a guarantee. It's not a promise. It's an example, a hypothetical example of how an insurance company is able to perform if their profitability were to stay at the exact same level over the life of that policy. Nobody can guarantee that, all right? Apple, Facebook, Google, nobody's able to project out their profitability like that to say every single year we're going to be at this same number, that you can take it home to the bank like that. That doesn't happen. But as the company becomes more profitable over time, those dividends are released or shared to their policy owners. And the way that we design the policy is that dividend would then purchase additional insurance. And what that does is that allows your death benefit to continue to increase, and it allows your cash value to continue to increase each and every year. That's why this gets better. It only gets better.
Yep.
Within the illustration, though, there is the dividend, a portion that is guaranteed and not guaranteed. Okay. When a dividend is released and it's part of the non-guaranteed side, once it is released to the policy owners, that cannot be taken back. It is locked in as cash value. And the way that we design it, it purchases additional insurance. Your death benefit will never decrease. Your cash value will only decrease if you're taking out a policy loan or a withdrawal. But the insurance company cannot reduce the cash value without you knowing, and they have no way to do it other than what you can do as the owner, either as a withdrawal or a policy loan. Guys, any other thoughts about illustrations, what you think might be pertinent for listeners to understand when we're talking about them? And why is it not necessarily so important to get caught up over the illustration and the numbers on the page?
I think they are very helpful. I know for my wife, when she saw the illustration, for some reason, all the dots connected and the wires I don't know, but she understood it after understanding the concept a bit more and then applying it to the illustration. So I think it's more of just a helpful tool to see actually where these numbers are going, actually, ballpark within, single digit percentages. It's not going to be a wildly different, number of your cash value compared to what the illustration is showing. But to see what that looks like and actually have that goal that you're looking towards, you're able to actually project out, it really helps people's mindset, peace of mind, and future opportunity that they're going to be looking for.
Yeah, another place the illustration along the same lines, John, is I've illustrated a couple child policies for some clients I'm working with, And if you look at a child policy, like if you're a parent, like for any parent who's listening to this right now and you are thinking, considering, or you have a 529 plan, you know, we can't give financial advice, go talk to your certified financial planner. But if you look at the guaranteed, you know, and non-guaranteed portions, but typically historically over all, you know, these years, they're closer to the non-guaranteed side than the guaranteed, you know, much closer, as John was saying. You know, like you're getting into when they're like, when she's, I'm just looking at one now, like 40 years old, she gets 5x back at 40. She gets 10x back at 50. She gets 15x back at 60. And for a very small decrease fixed premium, it's mind blowing. And so if I was a parent and I was thinking of, do I want to do a 529 plan, which has so many restrictions run by the government, and who knows, they'll change it whenever they want to change it. It's finite. You can only use it for a small amount of things and you can't use it again. Why would you not rather set your child up with a infinite banking policy that they can do all the same thing, they can do everything and more that a 529 plan can do. And then when they're done with college, they have a banking kind of system vehicle that they already have in place to then take them past college and through the rest of their working lives and then provide a legacy to their children. It's such a powerful tool. And if you look at the illustration, that many years out for a child, it really blows you away when you look at it. So it's super powerful to see that and what kind of impact that could have on your child and your grandchildren's lives.
I like to think of it as kind of just like a respectful declining to partner in business with the government.
Yeah.
And we talked about 529. There's also, you know, very close parallels, 401k in a different context. And you're respectfully declining to partner with the money managers who have fees that aren't just 1%. Like in actual dollars that you can use, it's closer to 30 to 35% of you know, usable dollars that you're losing in say a 401k with like a 1% management fee. So you're just respectfully declining. You know, I'm not going to do business with you. I'm going to actually keep, you know, those portions of what you thought you were going to take and keep it for my kids and for my grandkids, like you were talking about, Rob.
Yeah. Yep. So true.
Yeah. So just to describe a little bit more, Rob, when you're saying a 5x, what I think you're meaning is for every dollar of premium paid at that age,
yep,
you would have $5 in increase in cash value.
Cash value. Yeah, exactly right. Yeah. Yeah. Thanks for clarifying that. Yeah. It's crazy. It's like, why would you not want to do it? It's all guaranteed. It's independent. It's a contract. You're not at the whim of a government or the markets. It's all under your control. You know, and that's what I think an illustration, if you show a parent that and compare that to a 529, like, look at this, look at you with a 529, like you have no idea what's going to happen with it. You could lose it all. You literally could lose it all.
Yeah.
And I don't think parents get that. And I think because they don't know there's an option, right?
Yeah.
They don't know. And so hopefully we can help them with educating them in that way.
Yeah, and that's a great point. Nelson does describe that as well here. When you're thinking about whole life insurance, just the fact that it can never go down, always guaranteed to get better over time, unlike anything that's tied to a stock market.
Right.
You're exposing yourself to the risks of the stock market. And when thinking about a 529, you know, man, wouldn't it be unfortunate if the market goes down 25% right as your kid needs to go to college?
Right.
Now all of a sudden you don't have those funds, and it could take several years for the market to recover, and your child might be out of college at that point.
Or your child decides not to go to college.
Yeah.
Now what do you do? Yeah.
Yeah, absolutely. So guys, we're going to move on. We're going to talk about a dividend and how the IRS describes a dividend and classifies it as a return of premium. Dave Ramsey loves to harp on that. He says, look, the insurance company is charging you so much above and beyond what you should be paying for insurance that the dividend is really just saying, oh, look, we couldn't use it all. We're going to give it back to you. Or we charged you too much. Here you go. Here's a refund. When we look at an illustration, though, that doesn't make sense. I'll just describe an example here. maybe you've got a premium of $10,000 and you've paid it over 30 years. So all in all, your premium basis is $300,000. But the total dividend that the policy has received and the cash value and the death benefit, all of that is way above $300,000. So a dividend, even though it's classified as a return of premium, it's much more than that. Would you guys agree? How would you like to nuance that a little bit more?
When I heard Dave Ramsey's description of return of premium and how it's, his description, a terrible way to spend your money and you're just getting overcharged, immediately where my mind went was, oh, that's what tax withholding and getting a tax refund feels like. And that's actually, more closely what it is rather than a dividend is your tax refund. Like I used to honestly get excited about a little tax refund coming because I thought it's just free money coming my way. But really you're just, you're tipping the IRS, you're loaning them extra money than what actually you're required to pay. And you're getting some of that back without interest, by the way, without any sort of growth factor to that. And there's also, economic value added to that. But on the dividend side, yeah, if you look at the illustrations like we talked about and you see that dividend growing and you see that it's tax-free and you see that you can use it for so many different things, like that will assure anyone who's looking at that illustration that it's not just as simple as that, and it is definitely not a negative thing to get that tax-free dividend.
Yeah, and then the way we design those policies is that dividend, the way that Nelson teaches, is that dividend that the insurance company issues, that's an option as part of the policy. You can just have it happen automatically. It just is used to purchase more paid up additions, more permanent death benefit. And so that's why you always see the death benefit increasing, which means the present value of that death benefit, the cash value is increasing. So it creates this multiplier effect. And so, yeah, it's just financial celebrity kind of talk. But if you actually look at a policy and you see it out over time, the amount you get back is way more than this quote unquote return of premium that financial entertainers talk about.
So I want to talk about just the fact that dividends, how they're calculated, how they're decided upon, and what these life insurance companies actually consider. So when a life insurance company considers how much they should charge the policyholder for premium, they take into account so many different factors, right? They take into account the growth that they can expect on that premium over the life of the policy. They take into account the likelihood of, death claims that they're going to have to pay out throughout that time. And a side note on that is there's something called mortality tables that's actually shown, I think on page, well, I don't know which page specifically, but it's in Become Your Own Banker. And you can see kind of an example, really old mortality table, but these actuaries are the ones who just to a science can take the growth expected, the mortality rate, and all sorts of other factors and boil it down to an exact dollar amount of how much premium will be required to pay out that death benefit for the company's benefit and for the policyholder's benefit. And every year, at the end of the year, he talks about it in this section that we're in Becoming Your Own Banker, they'll say, okay, well, how did we do last year? And part of that is they're going to see, well, we expected this many people to die and pay out X amount of death benefit, but actually only this number of people, and say it's less amount of people died. And so we actually paid less in death benefit claims than we had planned for or expected. And actually we planned for a modest level of growth, and our investments actually gave us a higher number. And so what that's all going to contribute to is called a surplus, right? And if it's like a stock company, right? If it's like Coca-Cola, that surplus is going to be paid out via dividends to the stockholders. But because we're in a mutual company, and we are the owners of the company, similar to a stockholder, we're the policy owners, we receive that surplus in a dividend, right? That's why they're able to pay it out. And it's kind of a divisible surplus is what they'll call it, based on a better experience than what they had planned for. And generally, they're going to plan in a very conservative manner, very similar to engineers, right? I have a mechanical engineering degree, so I could speak mostly to it. Truthfully, I'm not, a seasoned vet, civil engineer who designs bridges every day. But I do know that in some of the courses that I take, they have what's called a safety factor. And if I'm designing a bridge and I know the maximum load that's going to be applied to that bridge is, say, 100,000 pounds, I'm going to design that bridge for a safety factor in excess of that 100,000 pounds. So probably 2, 3, maybe even 4 times what I expect to be a load on that bridge. So I'm going to design that bridge to take, 500,000 pounds, right? So that in any case, I know this bridge, for example, is safe and not going to fail. And that's very similar to what these actuaries do in designing policies. They're going to give the policyholders a sense of guarantee and assurance that they're designing these policies conservatively and that they're not going to fail and that the company's not going to be over leveraged or extended, and they're going to be able to pay out those death benefits first and foremost, right? That's the purpose of life insurance, is to have that death benefit. But in addition to that, they're going to plan for their growth and their mortality experience conservatively, so that they, in worst case scenarios, they pay it out. And in a better case scenario, all the policyholders get dividends. So that's maybe a long-winded answer just to say that these actuaries are really good at what they do. They design the policies conservatively, and we as the policyholders just get the benefit of their, wisdom and their planning to then produce the dividends for us that, by the way, continue to grow every year over the life of your policy.
All right, ladies and gentlemen, just to conclude the conversation for today, what we've talked about, right? Just the fact that you do finance everything you buy. Your capital or your cash has a cost associated with it. Either you're paying interest to a third-party bank, or you're giving up interest by paying cash for something, and you're disrupting the compounding that your capital could have had if you didn't use it the way that we describe it here with the infinite banking concept. We've talked about the responsibilities of an owner, how they need to maintain and utilize the policies properly. And then we've gotten into a lot of the technical details about life insurance and mutually owned whole life insurance. If this is a conversation that you're interested in having with us, I encourage you to, one, subscribe to the channel so you don't miss out on future episodes. But secondly, you can send us an email at thefamilybankingshow@gmail.com, and you can schedule a time to meet with one of us 3. And we'd be happy to flesh out more of these details for you and to show you, illustrate for you what the potential is of these policies and how it can help impact you and your family for generations to come. All right, guys, in the next episode, we're going to be moving on to the second section in Nelson's book, talking about the human problems and the temptations that we need to resist as owners of these policies and how to treat them with respect.
Mm-hmm.
Till then, guys, I hope you have a good week, and we'll catch you on the next episode.
Sounds good. Thanks, guys.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.